Good evening, good afternoon. Thank you all for coming. I'm with Craig Nehamen from Fair. Craig, how are you?
Good, pleasure to be here, thanks.
So tell us all a little bit about Fair, where Fair came from, what your role in all this was, and what the future of insurance is as far as you guys see it at this point.
Perfect, yeah, so thanks for having me. I am one of the co-founders of Fair.com, and Fair is an auto subscription that allows customers to get a car for as long as they'd like and return it anytime, and it is completely digitally. So customers access cars on an app where they can shop by all-in monthly payment, which is a really unique thing to achieve in auto. Interestingly, customers spend more time researching a car purchase online than any other purchase. It's about 14 hours. And the entire time they're doing it, they're looking at a price that often is not reflective of what they'll pay. They'll make a payment. 90% of customers finance their car. So we, by admitting you into an app and taking a few pieces of information, can finalize the price of the car, your rate, and all of the other things you'd otherwise negotiate, like warranty, maintenance, and roadside, and bundle those in and self-insure them, so that when you're shopping by a true payment, which is what you'll pay. And at that point, once you pick a car, you can sign entirely digitally on the app. There is no other way we know of to get a car from a dealership without signing state and DMV paperwork. And it's worth noting that we do not populate a small subset of cars. We actually populate tens of thousands of cars from thousands of dealers and wholesale channels. So you're accessing the greater universe of cars, and you're just able to subscribe to it as opposed to getting a loan. And then at that point, once you sign, you can opt in for insurance, and we can get into that in a little bit. And then you pick up your car, and if you like it, you drive off and have it as long as you'd like.
So where did this idea come from? How did you come up with it? What was the process of developing this company? Give us the origin story.
Absolutely. So our CEO, Scott Painter, is a bit of a storied entrepreneur in auto and tech. Before Fair, he was the founder of a company called TrueCar, which he IPO'd. And before that, a company called Cars Direct, which IPO'd under Internet Brands. So Scott, myself, and a couple of other co-founders got together, and we basically started with identifying a couple of issues that we saw as maybe for the first time solvable in auto. The first is that people still spend 5 hours at a dealership getting a car. 90-something% of people still get a car the traditional way, and no one really likes that, so it seemed like something important to try to attack. And the second is that really the only way to get a used car right now is to pay cash or get a loan. And most people can't pay cash, so most people get a loan. But a loan is actually not a great financial product for a lot of people. Either you need flexibility and getting a 6-year loan just doesn't make any sense for you, or you don't have perfect income or perfect credit, and a loan needs you to pay 60 or 72 times in a row, which you often can't do, so it has to overcharge you to compensate for the risk that it's taking on, trying to get you to do a thing you can't do. And we thought there has to be a better way.
Yeah, it's funny because when I first started reporting on fintech and new ways to buy cars and new ways to handle insurance and all this kind of F&I stuff that anyone who's ever bought or leased a car is familiar with, I was reminded of a time when I was going to take a trip out to Los Angeles and spend a couple of months there, and this was back in the late 90s, and I needed a car. And I thought, well, there must be some way for me to get a car for just a couple of months without borrowing it from somebody. So I did some, the internet was very rudimentary at that point, so I just picked up the phone and made some calls. And it was impossible. I could not get a car. I had to go to a rental car agency and rent the car for a couple of months and pay their basically monthly rate, daily rate kind of thing. And there was no way for me to just get a sort of short-term lease on anything. It was very difficult. So when I first encountered you guys, I thought, well, where were these guys back in 1998? When I really needed this service. So is that the kind of experience you've had with the business so far, where people they're looking around, they want to buy a car, and they encounter you guys and the light kind of goes off? Has that been your experience so far with the development of the business?
More so now than at first. So interestingly, this started out as something that you really don't understand until you experience it. I'm a customer. When I first got my first Fair car, it was the moment after I got it that I realized, well, I'm not stuck. I can return it any time. And it was this liberating moment. And now, for the first time, as people start telling their stories, our traffic has gone from paid to organic. Whereas we were paying for 90+% of our customers at first, we're now paying for half of our customers. So we're starting to see that the light bulb is going off, but more organically as people tell their stories to others.
Tell us about your customers. What kind of customers do you have? What kind of demographics are they coming from? My assumption is that they're probably on the younger side as opposed to the older side, which is not necessarily a bad place to be these days. So talk a little bit about that if you can.
You're right, they do skew younger. So our audience skews younger, and it also skews more female. And part of the reason for that is there's a lot of research that shows that women dislike the dealer experience even more than men. And it's off-putting and uncomfortable. So this offers a better way to access the car. And then also, it's worth noting that our customers are across the credit spectrum. We have use cases, as I mentioned, in non-prime, near-prime, subprime, when we're actually just cheaper. And in prime, where we're comparable to your other financing option on that car, but people that need that added bit of flexibility will go with us. And then interestingly, there are these little niches, like military, where military tends to actually skew a little less prime, but also in case of deployment, you need that added flexibility. And it turns out that these niches are not small. That's a $5 billion TAM. And even students, for example, is a $5 billion TAM, totally underserved, no credit, very little income.
How's the business looking these days? How are revenues looking? What's the scale?
Yeah, so we kicked things off in August of 2017 in the App Store. And about a year ago, we were completing around 10 contracts or so a day. So very little business. Since we have scaled the business pretty dramatically, we are now in over 30 markets. We are doing about $100 million of business monthly now. So we've sort of 20x'd in terms of daily volume, which has been really exciting. And about half of that is on the consumer side, and half is actually in rideshare. So along the way, we purchased Uber's leasing business, which was called Uber Exchange. Yeah. And alongside that purchase, we took over an exclusivity to be the rideshare provider for Uber for a non-rental option. And to us, that was a really important thing to a brand new company to basically eliminate customer acquisition cost risk. So both of those businesses are scaling in parallel. And right now we're seeing as noted, a little bit over half of the business is rideshare, and close to half of the business is consumer.
When you were smaller and you weren't signing as many contracts every day, did you have that founder situation where you said, we don't know how this is going to go? Or were you confident in the business plan, confident in the business opportunity, and you knew it was going to get, you had a good opportunity to get to the place where you wanted to get to?
So
this is like did you have a moment of panic question around the business at that point?
So the question should be, how many moments of panic did I have? Many moments. But our CEO likes to tell this sailboat analogy. The other couple of co-founders had never done something like this before, and he had done it a few times. So he would always try to calm us down by saying, we're all on a sailboat, and you just feel the wind blowing the sail, but I actually know what happens next, which you take the mast and you put it over here, and you're going to catch sail, and you're good to go, and you're going to be out in the ocean soon. So that speech had to happen a few times. There were many road bumps along the way. You have to understand the complexity of what we're doing is, we'll get into insurance in a second, but we're self-insuring multiple items. We're offering insurance. We're taking asset risk as we're actually buying and leasing these cars effectively. We now have a more similar to rental product. And we also have capital risk because we have to finance not just the business, but we actually have to finance these cars through both debt and equity. So throughout our journey, we've raised a little over $500 million in equity and about $1 billion in debt. And that's been a difficult thing. At the beginning, actually, one of the biggest questions is, can we finance this new sort of asset class or financial product with traditional debt? And if not, we'll pay too much and we can't be competitive. Yeah. Fortunately, we've evolved a lot, and we've found that traditional banking has really embraced us. And we have great partnerships with Goldman Sachs, Credit Suisse, our own bank, Silicon Valley Bank, and others.
So a quick follow-up on that. Why do you think traditional banking has embraced you? That's part one. And part two is, can you just tell us a little bit about the mechanics of the insurance side here? Like if you want to participate in your product, if you want to do something with your product, how do you handle the insurance component of it?
Absolutely. So interestingly, the reason why traditional banking has actually turned out to be a great solution for us is in order to make it work that a customer can return a car anytime, you must limit your exposure. Because typically that would be called default. The customer returns the car in a year, that's actually a really bad thing and you take a loss. When we had to make it a true statement that if you return the car in a year, we don't take a loss or we don't take much loss. So what we had to do to construct this product was buy cars very well so that we have really strong collateralization, minimize uncollateralized risk, so we don't finance tax because we're not a loan. We don't finance products like warranties and things like that. We self-insure them so that we, day one, are completely equitized. And from there, we then basically have a continuous view of depreciation so we can keep up with the depreciation curve throughout the life of the contract. Right. And then to move on to your question about insurance, so insurance is a really big part of what we do. And we believe, and if you don't mind, I'll maybe speak a little bit to how we see insurance.
Sure.
We believe that part of the reason why the top 10 insurance providers have 75% of insurance customers in auto is because customers are accessing cars the traditional way. So as a result, they must access insurance the traditional way. And there will continue to be huge penetration across tier one insurance providers. But what we're seeing is when we get the customer into our ecosystem, we already know a ton about them. So we were very easily able to achieve a one-click bind. And we didn't even realize that that's an innovative thing. For us, it was actually just an organic, natural thing to do. We knew so much about them. They say, show me the rate, we run an MVR, and we're good to go. That's literally all we need to do. So as a result of that, we have over a 60% take rate on our insurance product, doing very little and pricing at, or maybe even, I believe, a little bit above market rates. So what we're seeing is customers are taking to this holistic view of if I'm getting my car here, it's easier to just do it all there. And as a result, we're seeing that sort of penetration, and there's no associated marketing costs with us for those customers. So our expense ratio is naturally lower. And then the last thing I'll speak to in terms of why we believe that our app is interesting for insurance is everybody who gets a car has the app. So as a result, we can very intuitively drop software-based telematics and do it with full disclosure in a completely anonymized fashion. So we can put an SDK in the background and we can offer drivers coaching and haptic feedback. We can memorialize and timestamp first notice of loss. And all of those things not only increase safety for drivers, and for the first time, by the way, the phone, which used to be a thing that made driving less safe, can actually help make driving more safe, which lowers claims costs, lowers claims-related expenses, and we can, as a result, have a more competitive product for customers. So we actually think that this idea of offering insurance through our ecosystem is a really powerful part of what we do.
You think it's revolutionary? I think that's the potential to really change the way business has been done. I mean, my experience buying and selling numerous cars and, buying and selling houses and all that kind of stuff and having to deal with insurance as an issue throughout my life has always been, well, it's just part of this system. I'm going to have to go if I want to buy a new car and spend some time with the F&I guy. That's just part of the deal. I'm going to be there all day long. I'm going to sit down in an office. I'm going to sign a whole bunch of papers. He's going to explain this to me. I'm going to tell him, well, I'm just bringing my own insurance company in here that I've had with all my other cars. That's the way I'm used to doing stuff because I'm, not a young person, but young people have lower levels of tolerance for this kind of thing. So do you think that the efforts that you're making are potentially revolutionary in terms of how we, undertake this process, at least in automotive?
I would be irresponsible to already claim revolution. But we believe that they're a really important part of the evolution of auto. And we do believe that for most people, a loan doesn't work. And as a result, evolving past lending is a really important thing. Obviously, there are a lot of people who want to own a car.
Yeah.
And we're not at odds with all lenders. We partner a lot of banks and lenders, but we do believe that there is a change. We have seen some research that indicates that the aptitude and intent associated with subscriptions is really high. So getting it right and scaling it and execution are probably our biggest risks.
So you are really invested in the idea that people are going to own vehicles. They may not own them in the way they have in the past, but they're still going to own them. I mean, there's been a huge conversation in the auto industry. It's been going on for years now about what's going to happen with people who are, basically under 40. Are they going to want to own cars? Are they going to want to have some sort of different relationship with mobility? From your perspective, as far as I can discern, is that you think people are going to own them. They might just own them in a way that's different than what we've seen before. I mean, is that accurate?
It is accurate. A car is a really important part of somebody's identity. It's also really inconvenient in a lot of cities not to have a car. Think about a mother of two that has 2 baby seats in the back and a whole bunch of stuff in the trunk. Good luck telling her she's not going to own a car and she's going to ride hail all over the place. So we see and will continue to see more and more ride hailing as a complement to ownership, but not as a replacement. And we haven't seen evidence of less ownership to date, despite everything that's happening with ride hailing. And to your point, we absolutely believe that people will be owning differently and are demanding flexibility.
Yeah, in a lot of ways, we have higher levels of ownership and leasing than we've seen in a long time. Record years in the United States,
Yep.
certainly. So, right now you have a relationship with Assurant. We've talked a little bit before this conversation about how you're trying to develop your own captive insurance capability. Tell us a little bit about how that's going and what your expectations for it are.
Yeah, so the natural starting place for us was to act as an MGA and to broker a commercial policy through a partnership. Assurant has been a spectacular partner to us and an important part of our growth as a business. So right now we offer a commercial policy that they're insuring on both the consumer and rideshare sides. We are evolving and in many ways with Assurant and also of course other partners to forming a captive now so that we can start to take some of our own risk. We will certainly not do so all alone and jump into taking complete first dollar and catastrophic risk across our program. We will, in certain lines of business, jump in more rapidly than others, probably a little bit more slowly in rideshare, but we will look to risk share at first. We will look for catastrophic insurance and for insurance past a certain liability limit. So we will be thoughtful and partner probably a lot of the people in this room as a data customer to put together programs and to share risk.
We talked a little bit beforehand, and one of the things that you said was we like risk. We love risk. Because when I first encountered the company, I thought, well, this is an interesting business model, what they're doing here, but boy, oh boy, are they taking on a lot of risk. Not only are they a startup, but they're doing all this other stuff that's relatively risky, at least in my estimation. And your reaction when I asked you about this was, no, we like that. We like risk. So tell us a little bit about your overall relationship with risk and how you feel about it within the context of this business.
So with risk comes control of the experience. So if somebody else is taking the risk, that other entity controls the underwriting, they control the inputs, they control the onboarding experience in many ways. Furthermore, there is an economic inefficiency oftentimes associated with third-party risk. Now, that is a statement that is far too bold without caveats, but we knew early on that on the auto side, we couldn't even close to achieve what we wanted to without taking the risk. And if you are not the principal in the transaction, it could not be all digital. That was a binary truth. So we couldn't do the first thing we wanted to do, which was go from 5 hours to 5 minutes as opposed to 5 hours to 4.5 hours. Yeah. So that was absolutely critical, and we couldn't offer the product that we've offered. And furthermore, I think one of our biggest competitive advantages that we're developing right now is the aggregation of data associated with our product. No one else has nearly as much data as we do on subscriptions. So when we underwrite new customers, we, to a level of statistical significance, know how long they'll keep the car and how many payments they'll make, which is powerful. And we wouldn't know that and have the skill set to underwrite to that had we not thought about risk as an advantage or a competitive point early on.
How do you look at your competitors? I mean, who do you think they are, and how do you sort of assess your position in the competitive landscape?
So first off, subscriptions are so young that we are not competitor averse. The more subscription models out there that prove
this is a great point. I always think this doesn't get made enough, which is that, okay, it's wonderful to be the monopoly player in the market, if you can achieve that, but that's its own burden. And then you don't want to be an army of one in some of these situations. You do want to have at least an ecosystem of competition out there because it makes everybody better, and furthermore, it shows that there's a market.
100%.
Yeah.
I mean, we don't want to educate the whole market alone. That's really costly.
Right.
So we welcome new subscription models. We don't see ourselves as directly competitive to OEM subscriptions as they're focused on new cars, and our model only really functions on pre-owned and certified pre-owned cars. It's part of the reason why we're partners with OEMs. Mercedes and BMW have both invested in Fair, so that's an important note. We do see some subscription models popping up. Cox has a couple models and starting to gain a little bit of traction, which is encouraging. And obviously, there is a level of competition between us and a loan, because oftentimes a customer is choosing between us and a loan. And not only that, but one of the things that we've been seeing more recently in our business is most customers access auto finance through the dealer. So they go to the dealer, they pick the car, the dealer says, fill out this credit application. Here are some options to finance, or here is your option to finance the car. Dealers are now actually submitting those applications to us right alongside a loan and coming back to the customer and saying, do you want to get out of here in 5 minutes? So we are actually sitting beside them in that atmosphere now.
Okay, self-driving cars, autonomous vehicles, all anybody wants to talk about at some level. How does that fit into your business? Does it fit into your business? What do you know about it? What do you think about it?
So we believe that so self-driving cars are coming. We are, I guess, close to L3 right now, and there's research that indicates that actual robotaxis in non-inclement suburban environments within 2-3 years will be a thing in pilot in a real way. So the technology is close. However, like we were discussing before, even if the car is driving itself, you still want your own car. And you still probably want flexibility on that car. So we're here to help, whether the car is autonomous, not autonomous, whether that autonomous car is part of a ride-hailing fleet, and we can continue to build on our partnership with Uber, which we care deeply about. We think that flexible ownership applies.
All right, in the time we have left, we're going to play a little game called Overrated, Underrated. I'm going to read out a couple things to you, and you can tell me if you think it's overrated or underrated. So we just talked about autonomous vehicles. Overrated or underrated? I guess correctly rated could also be an option here.
Wonderful. I would say correctly. Thank you for the third option.
It seemed like it was kind of cutting in that direction.
Correctly rated. Autonomous vehicles are coming. The technology is closer on L4, probably 10 years out on L5. But at L4, it's meaningful and matters to this world, matters to insurance, obviously, and to the way that ownership looks.
How about Waymo?
So Waymo, when you look at the most successful autonomous driving miles and without disengagement, which is the key metric on the actual state of technology, they are ahead of the curve. So underrated and making great strides.
Okay, how about subscription efforts by traditional car makers, OEM subscription models?
Overrated to date. They have very little penetration. I'm rooting for underrated.
Okay, how about car loans? Just generally, traditional car loans.
Well, I can't say everything I just said and then say anything other than overrated.
Right.
But when I say overrated, I say it with the caveat that they are an important option for a lot of customers. And overrated doesn't mean not necessary.
Absolutely, absolutely. Well, thanks for your time this afternoon. Great conversation, Craig. Really appreciate it. and looking forward to seeing how the business shakes down.
Thank you.